Hello everyone, welcome to Tesla Daily News. Today is July 12th, Saturday, and the following is the latest Tesla news. According to Clean Technica, Australia's car market is undergoing what industry leaders are calling a structural and even paradigm shift toward electric vehicles, with Tesla playing a central role. In June 2026, of about 140,000 light vehicles sold in Australia, almost 36% came with a plug, either fully electric or plug-in hybrid. That is roughly double the plug-in share from a year earlier and triple the penetration seen in January of this year, indicating a powerful acceleration of EV adoption. Clean Technica notes that the Tesla Model Y was the best-selling vehicle in Australia across all powertrains in June, not just among electric cars. It recorded 8,702 sales in a single month, putting it ahead of traditional best-sellers such as the Ford Ranger and Toyota Hilux. Year to date, the Model Y has already surpassed 20,000 sales in the country, while the electric vehicle share of the overall market is rising and pure petrol and diesel sales are falling sharply, with petrol down almost 30% and diesel down nearly 20% year-over-year. For investors, this Australian data reinforces Tesla's global strength of brand and demand, even as competition from Chinese manufacturers like BYD intensifies. The article highlights that BYD is now the second best-selling auto brand in Australia behind Toyota, with multiple models in both the pure electric and plug-in hybrid segments. Yet despite a broader Chinese wave, Tesla's Model Y still tops the charts, confirming that Tesla can maintain leadership in key markets even as newcomers gain share. This provides some counterweight to concerns that Chinese EV makers will rapidly erode Tesla's global position. According to Clean Technica, Tesla's lineup in Australia is also expanding with the introduction of the Model Y long-range variant, which reviewers in the article describe as strong value for money. The presence of more variants, including longer range options, should help Tesla capture additional segments of the Australian market, especially as infrastructure improves and more households pair EVs with rooftop solar and home batteries. The narrative from Australia is that charging access is expanding, total cost of ownership is becoming more attractive, and high fuel prices tied to conflict in the Middle East are pushing more buyers to consider electric options. From the point of view of a Tesla shareholder, Australia is a relatively small market in absolute volume but a highly symbolic one. For years, adoption there lagged many developed markets, and local industry voices were skeptical of EVs. Now, even the head of the National Automotive Lobby is acknowledging a paradigm shift and a likely permanent structural change in consumer preferences. This suggests that Tesla's early investments in right-hand drive markets and in global supply chains are paying off. It also supports longer-term assumptions in many Tesla valuation models that EV adoption will continue to rise as infrastructure, policy, and economics align. Turning to North America, the Motley Fool discusses whether investors with $1,000 to allocate to electric vehicle stocks should choose Tesla or Rivian. The article frames Tesla as much more than just an EV manufacturer, emphasizing the company's growing focus on autonomy, robotaxis, and humanoid robots. The Motley Fool points out that Tesla recently regained its status as the global leader in EV deliveries in the first quarter of 2026, after briefly losing the crown at the end of 2025. According to the Motley Fool, Tesla's Model Y remains the world's best-selling car, and Tesla's quarterly deliveries recently climbed to about 480,000 vehicles, up roughly 25% year-over-year and ahead of Wall Street expectations. Despite this, the stock sold off, in part because investors are now focused on future high-growth initiatives like robotaxis and the Optimus humanoid robot, rather than traditional vehicle metrics. The article notes that Tesla trades at a very rich forward price-to-earnings multiple, around 178 times, which is primarily justified by potential upside from autonomy and robotics rather than current automotive margins. The Motley Fool also highlights that Tesla is investing heavily in artificial intelligence to power both its robotaxi platform and its humanoid robots. This spending will likely compress margins in the short term, but if management executes successfully, the payoff could be very large over the coming decade. The company has already launched a robotaxi service in Miami, which is still in early stages but provides valuable real-world data for training its self-driving system. There is also anticipation about a possible reveal of an updated Optimus robot later in July, which could serve as a catalyst for investor sentiment if the technology appears commercially viable. On Rivian, the article notes that the company recently launched the R2, a mid-size SUV positioned at a much more accessible price point than Rivian's earlier, more premium models. Rivian's second quarter deliveries beat the high end of its own guidance, helped by the R2 launch. The company is also pursuing its own self-driving capabilities and has signed a deal with Uber to deliver up to 50,000 fully autonomous electric vehicles by 2031, in exchange for a possible $1.25 billion investment from Uber. However, the Motley Fool argues that despite Rivian's promising story, Tesla remains the better choice for most investors. Tesla already operates at scale, has stronger brand recognition, a global manufacturing footprint, and the ability to cut prices more aggressively without destroying its economics. Furthermore, Tesla can fund its expansion and research primarily from internal cash flows, while Rivian continues to rely on equity issuance and remains unprofitable. From an investor's lens, this comparison reinforces Tesla's status as the default large-cap EV play. The risk-reward profile is heavily tied to whether Tesla can turn its software stack, full self-driving technology, and robotics into profitable businesses. Yet compared with Rivian, Tesla has more diversification, greater resilience, and more room for error. For Tesla enthusiasts, the key takeaway is that mainstream financial media still see Tesla's competitive advantages as durable and its upside from AI-powered initiatives as substantial, even after years of stock appreciation and volatility. Shifting to Europe, Jornal Económico in Portugal reports that Tesla has staged a strong comeback in European sales rankings after what the article calls an annus horribilis. The story notes that in Portugal, the Tesla Model 3 was the best-selling car in June across all powertrains, leading national sales for the second consecutive month. Within the European Union, Tesla's deliveries have surged about 77% during the first 5 months of the year. According to Jornal Económico, this European strength has led Tesla to a global quarterly sales record in the second quarter, largely driven by the continent's rebound. Analysts quoted by Reuters in the Portuguese piece suggest that Europe is now the main growth engine for Tesla, while US sales appear weaker and China shows only modest growth. Importantly, the article emphasizes that rising fuel prices driven by Middle Eastern conflict and disruptions in oil supply, particularly at the Strait of Hormuz, have pushed European consumers toward electric vehicles. In this context, electric vehicle sales in Europe rose around 15% by May, reaching about 20% of total new car sales, and Tesla's aggressive financing strategy has significantly boosted its competitiveness. Jornal Económico reports that Tesla's financing rates, which were at 0% earlier this year and are currently around 1%, are dramatically lower than those of traditional rivals. Essentially, Tesla is intentionally compressing its profit margins to make purchase prices more attractive, aiming for higher volume in a fiercely competitive environment. The article also mentions a softer but important factor. Elon Musk has lately stayed away from contentious political commentary in Europe. After criticism for his past support of Donald Trump and far-right groups in Germany and the United Kingdom, his lower profile is seen as removing a potential barrier for some European buyers. A quoted analyst suggests that Tesla's product quality and pricing are now strong enough that many customers are willing to overlook any personal discomfort they might have with Musk's politics. From a quantitative standpoint, Tesla is described as the top fully electric brand in Portugal so far this year, with almost 6,300 units sold, more than 50% growth versus the previous year. BYD and BMW trail by a wide margin in pure EV volume. Broader electrified vehicle sales in Portugal, including hybrids and plug-in hybrids, have also hit record highs, with electric models growing more than 60% in June alone. For Tesla investors, this European and Portuguese rebound suggests that the company can pivot geographically to offset slower regions. It shows that flexible pricing, attractive financing, and a strong product lineup can reignite growth, even after a period of stagnation. It also demonstrates that high fuel prices and policy-driven support for electrification continue to provide secular tailwinds for Tesla across Europe. Moving from vehicles to space, Expansion in Spain analyzes the early stock market performance of SpaceX, now a separately listed company. While this is not Tesla directly, it is important for Tesla investors because both companies share a founder, a technology culture, and exposure to artificial intelligence and infrastructure themes that can influence how markets view Musk-led ventures. According to Expansion, SpaceX completed the largest initial public offering in history on June 12, listing on the Nasdaq at $150 per share, above its offering price of $135. The stock quickly climbed, closing that first day at $161 and later hitting an intraday high above $225, implying a market capitalization above $2 trillion. However, within a week the price corrected sharply down toward the high 140s, reflecting both company-specific and sector-wide concerns. Expansion points to several triggers for the correction. Shortly after the IPO, SpaceX announced its largest acquisition ever, the purchase of artificial intelligence programming platform Anysphere, owner of Cursor, for roughly $60 billion in stock. This caused immediate dilution and raised questions about capital allocation. Next came first quarter 2026 results, with SpaceX posting a net loss of about $4.3 billion. The company then issued its first investment-grade corporate bonds, seeking to raise around $20 billion but ultimately upsizing to $25 billion due to very strong demand, with maturities stretching from 2031 to 2056 and yields ranging from about 5.35% to 6.65%. Although demand for the bond deal was heavy, the trading performance after issuance was weak. According to Bloomberg figures cited by Expansion, credit spreads widened rapidly and investors suffered several $100 million of unrealized losses on the bonds on the first day of secondary trading. This shows that while there is enthusiasm for SpaceX's long-term promise, there is wariness about volatility, capital needs, and the risks inherent in ambitious technology build-outs. The article goes on to note that technology and growth stocks have faced a broader sell-off in recent weeks, driven by worries that interest rates could remain elevated, that AI infrastructure spending might not translate quickly into profits, and that high valuations leave limited margin for error. SpaceX is described as a hybrid company sitting at the intersection of space, defense, connectivity, strategic infrastructure, data, satellites, and AI. Its current losses are not viewed as fatal by many analysts, because the potential addressable market for Starlink and related services is enormous. Expansion reports that Wall Street analysts are generally constructive on SpaceX, with a consensus price target around $236 and a majority of buy ratings, including very bullish targets from some firms. Analysts at Raymond James, for example, see long-term upside to $800 and compare SpaceX's role to past foundational infrastructures like railroads, power grids, and the Internet. Still, other analysts such as those at Morningstar argue that much of the future growth is already priced in and recommend selling based on valuation concerns. For Tesla investors, this SpaceX narrative is relevant in several ways. First, it underscores that markets remain willing to fund very large Musk LED technology projects at high valuations, even in a more cautious interest rate environment. Second, it shows that volatility and heavy capital requirements are likely to be a recurring feature of Musk's ecosystem, from rockets to satellites to AI. Finally, it suggests that, just as analysts are focusing on Starlink, data, and AI as the real value drivers for SpaceX, equity markets may increasingly focus on Tesla's software and autonomy businesses rather than only its auto margins. Staying with space and Starlink, Opiniazok in Slovakia reports on leaked documents that suggest Russia and China have discussed coordinated strategies to weaken or even disable the Starlink satellite network. According to this investigation, carried out jointly by the Insider, Der Spiegel, and Le Monde, journalists obtained internal presentations from secret Russian-Chinese military technology forums held in 2023. These documents reportedly described Starlink as strategic U.S. military infrastructure and outlined a multi-stage plan to counter it. The plan described by Opiniazok begins with diplomatic pressure through international organizations to limit the expansion of mega constellations like Starlink. It then envisions coordinated efforts to occupy orbital positions and frequency bands, alongside the development of joint electronic warfare capabilities to jam satellite signals. A more aggressive phase includes cyber attacks on user terminals, propagation of malware through the network, and even physical destruction of satellites using low-cost systems capable of targeting multiple spacecraft. The article emphasizes that Starlink has evolved far beyond its original mission of providing internet to remote regions. It is now crucial infrastructure for militaries, governments, and commercial customers around the world and represents a key pillar of SpaceX's valuation. Any credible threat to its operation would therefore be a national security concern and a material business risk. The disclosure that Russia and China may be exploring joint capabilities against Starlink raises questions about broader strategic competition in low Earth orbit. Opiniazok also notes the irony that Elon Musk has cultivated positive relations with Chinese authorities for years. Tesla's massive factory in Shanghai remains one of its most important production hubs, and Musk has at times described himself as leaning pro-Chinese in outlook. Yet, according to these leaked documents, Chinese state-aligned entities are actively conceptualizing strategies to offset SpaceX's advantage in satellite communications, including possible disruptive measures. While this story does not directly affect Tesla's automotive operations today, it matters for investors because it highlights geopolitical risk attached to the broader Musk ecosystem. If tensions over satellite networks escalate, it could influence regulatory attitudes toward Musk's companies in multiple jurisdictions, affect public perception, and introduce new kinds of operational and financial risk. For Tesla enthusiasts, it is a reminder that the same visionary who builds cars also operates at the center of global strategic competition in space and communications. According to Echo24 in the Czech Republic, a recent incident in Canada has raised further questions about driver monitoring in Tesla vehicles. A family traveling on the Trans-Canada Highway reported seeing a Tesla Model Y traveling at about 100 km per hour with the driver apparently asleep at the wheel, and with two children also asleep in the car. The witness recorded video, which went viral on social media, and contacted emergency services. Canadian police are investigating the incident, which has not yet been officially confirmed. Legal experts quoted by CBC and summarized by Echo24 explained that if the driver is found to have been asleep while the vehicle was in motion, she could face penalties ranging from ordinary traffic fines to serious criminal charges for dangerous driving. If children were indeed present in the vehicle, further charges related to negligence or endangerment could also apply. The focus of debate, however, has shifted to the performance of Tesla's driver monitoring systems and the question of how the car continued to operate if driver attention was not being properly maintained. Echo24 cites reporting from Electrek, which notes that Tesla uses an interior camera above the rearview mirror to track the driver's face and eyes as part of its driver attention system. However, the company's own documentation acknowledges that this camera-based monitoring can fail if the driver's eyes are covered by sunglasses or a hat. In those cases, Tesla's system falls back to a more traditional approach that monitors torque or resistance on the steering wheel. In some past cases, especially in China, owners have even managed to fool camera-based systems by placing objects like mannequin heads in the driver's seat, tricking the car into believing an attentive driver is present. This incident, if confirmed, would add fuel to concerns among regulators and safety advocates that Tesla's current combination of hardware and software can still be circumvented or fail under certain conditions, allowing inattentive or sleeping drivers to rely too heavily on driver assistance. For Tesla investors, these types of safety controversies are important because they impact regulatory risk, brand reputation, and the timetable for monetizing advanced driver assistance and full self-driving features. While many Tesla supporters believe the company is ahead in autonomy, each high-profile incident invites scrutiny from agencies and may contribute to restrictions, recalls, or software changes that could slow feature rollouts. Balancing innovation with safety and perception remains a key challenge for Tesla's long-term autonomy thesis. Finally, the International Business Times in the United Kingdom describes a heated exchange between Elon Musk and New York City Mayor Zoran Mamdani that has rekindled debate over Musk's reliance on public money. The article explains that Mamdani criticized extreme wealth and the role of billionaires, prompting Musk to respond on his social platform X by calling Mamdani a taker who has built nothing and labeling himself a maker. According to the International Business Times, this comment quickly led critics to resurface a Washington Post investigation estimating that Musk-affiliated companies have received at least $38 billion in government contracts, loans, subsidies, and tax credits over the years. Online commentators argued that this level of public support undermines Musk's narrative that he succeeded purely through private enterprise. One organizer, Jay Ponte, pointed out that Tesla was founded by Martin Eberhard and Mark Tarpenning, not Musk, and accused Musk of benefiting from acquisitions, takeovers, and public funding while resisting unionization. In a widely shared response, Ponte called Musk a parasite and argued that most of his wealth rests on the labor of workers and taxpayer-backed support. The article also highlights contrasting political visions. Mamdani advocates for a larger government role in reducing living costs, including city-run services, stronger protections for gig workers, and higher taxes on wealthy residents. Musk, by contrast, routinely calls for smaller government and less regulation, even as his ventures benefit from contracts and incentives. This clash has fueled broader public discussion about how much credit entrepreneurs should receive for building businesses that rely on state support, and whether current tax and subsidy structures are fair. For Tesla shareholders, this narrative matters less for near-term earnings and more for long-term policy and reputational risk. Persistent focus on government subsidies could shape public attitudes during future debates about EV incentives, labor rules, and public procurement. If policymakers come to view Tesla and other Musk companies as overly dependent on state support, they might be less willing to renew subsidies or grants, especially in politically polarized environments. For enthusiasts, the exchange is a reminder that Tesla's story is intertwined not only with engineering and markets, but also with politics, inequality debates, and public perceptions of billionaires. That concludes today's episode of Tesla Daily News. Thank you for listening, and if you found this update helpful, please consider subscribing so you do not miss future episodes.